Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors.
Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. In this session, I want to get into the first quarter earnings season for the S&P 500, where really the companies in the index have demonstrated a good amount of resilience amid what has been a lot of economic uncertainty. And in some ways, therefore, and the numbers will show this, their earnings results are exceeding expectations. Now, even with that, though, there are a few sort of cracks showing, so we'll get into that a little bit. But, at this moment, as I'm recording, it's about 97% of the S&P 500 companies that have reported their first quarter results. And so let's jump into some of the specifics. So the first is to say earnings grew year over year at a much higher growth rate than was anticipated. So right now, that blended growth rate is estimated to be just shy of 13%, 12.9%. And yet, if we look at where things were when we started the quarter, so before earnings results started to be released, essentially the expected growth rate was 7.1%. So that's a pretty big jump, right, in terms of better than expected results. And actually, it was 78% of companies that quote unquote beat their earnings per share estimates. And actually, that's interestingly in line with the 5-year average of 77%. In any event, when it comes to revenue growth, similarly, a little bit better than expected. So an revenue growth rate of 4.8% compared to a forecast of 4.4. So, again, positive, maybe not quite as meaningful as the earnings side, but still notable. Now, when we look at sectors, there's some strong positive results in a couple places in different ways. The first I'd say is healthcare, where earnings grew by 43%. And one of the topics or items that's been attributed to is the increasing demand for weight loss drugs. Obviously, a big sort of thing going on in the healthcare space. In the technology sector, earnings increased by 16%. And of course, there's the sort of interrelated need for AI and cloud computing, demand for both of those things that are contributing to the strong growth there. Now, financials had modest growth overall, but notably, 88% of financial firms beat EPS estimates, and that's really from higher net income, just on average. And then on the negative side, for example, earnings growth in energy was actually down 13%, weaker demand a little bit, and declining oil prices themselves. Now, those well-known Magnificent Seven stocks, so Amazon, Apple, Google's parent Alphabet, Meta, Microsoft, NVIDIA, and Tesla, have all reported. And at this point, their earnings grew 28% year over year, first quarter. And together they comprised 31%, so almost a third of the overall index earnings growth. Now, another thing we like to do is sort of monitor some things that are kind of discussed in the earnings calls, right? Companies have these meetings and calls where they talk to shareholders and kind of explain what's going on. And punchline here is tariffs, of course, were very actively discussed. So 89% of companies mentioning tariffs, but notably, of course, there are a number that said, hey, there's going to be a negative impact, higher input costs or supply chain disruptions or both. But others saying that the impacts really could be quite limited. And so that, that's just a topic, obviously, that everybody's watching. So we'll keep looking at it through the lens of company leadership and earnings and all that. Now, interestingly, we're coming to the end of May, and there's been a good amount of recovery in the markets. And so despite, what was around numbers, a 19% decline peak to trough in the S&P 500 this year, there's been a good amount of recovery, and we're back modestly, just slightly above positive for a year-to-date return on the S&P 500. And so, just note that we're mindful of that recovery. And then, though, back to the concepts of pressures or headwinds, interestingly, of course, that brings the cap-weighted index back up to a rich valuation. So on a PE basis, basically trading about 15% above the long-term 10-year average, whereas the equal weighted index still sits at about a 1% discount. So as we've been talking about since the beginning of the year, we see the opportunity for the market to broaden out. If you're a diversified stock picker or use managers that take that approach, essentially it's a pretty good environment to find opportunity, and yet we're expecting the market to broaden out beyond a cap-weighted S&P 500 kind of dominated index environment and market environment. And so, again, back to the concept of potential headwinds, obviously the trade efforts, tariffs, uncertainty, these are all things that have sometimes been weighing on investors. And of course, people are watching to see how that translates through, if at all, to earnings and earnings growth. So again, lots to focus on as we go forward. That's anyway what we wanted to cover in this session. Thanks so much for listening this week, and we'll catch you next week. Thanks so much.
Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.